Have you ever wondered why your hard-earned money languishes in a bank, barely yielding returns that fail to keep pace with inflation? Or ever felt like your money is playing a never-ending game of hide-and-seek in the bank, vanishing behind paltry interest rates and concealed fees? So, where should you park your hard-earned cash for ultimate safety and growth? For years, we've been conditioned to believe that our money is safest within the confines of the bank. But what if I told you that the bank's comforting facade might be concealing a bitter truth? The truth is that banks have indirectly misled us, blinding us to the dazzling array of opportunities that lie beyond their vaults. While the banks offer a safe and reliable place to stash your cash, there's a whole world of opportunities out there that can not only preserve your wealth but also potentially grow it over time. With a twist of fate and a sprinkle of knowledge, today we unveil the well-kept secrets that banks don't want you to know, revealing a treasure trove of assets that preserve value better than cash and offer a gateway to financial freedom. Get ready to unlock the true potential of your cash when invested in any of the 15 assets we are going to discuss today that promise to rewrite your financial destiny. We will start with collectibles. Collectibles are tangible or intangible items that are highly sought after by individuals due to their historical, cultural, artistic, or sentimental value. They are not produced for the primary purpose of consumption or utility, but rather as items of interest and value appreciation. People collect these items, believing that their value will increase over time, making them attractive investment options. Let's dive in on collectible assets that are more valuable than cash and really sought after by rich people. Vintage cars. Vintage cars, also known as classic cars or antique cars, are automobiles produced between the late 19th century and the early 1980s and are typically over 25 years old. These vehicles hold a special allure due to their historical significance, unique designs, and limited production runs. Vintage cars have a unique charm that transcends time, capturing the essence of bygone eras. The primary allure of investing in vintage cars lies in their rarity and scarcity. As these classic automobiles age, their numbers dwindle, making them increasingly valuable over time. Unlike cash, which may lose value over time due to inflation, vintage cars have a strong potential for appreciation. Rare models, limited editions, and iconic brands often see substantial increases in value as time goes on. These models with iconic designs or those linked to legendary figures in the automotive world can fetch exorbitant prices at auctions as collectors and enthusiasts eagerly pursue these treasures, ensuring their lasting value in the market. The collectible market for vintage cars remains robust as demand is fueled by the emotional connection people have with these classic vehicles and the desire to own a piece of automotive history. Thus, vintage cars can offer a certain level of safety even during financial downturns, as they enjoy a loyal and niche market. Luxury pieces. Luxury pieces encompass a wide range of collectible high-end items such as luxury watches, jewelry, handbags, luxury accessories, and rare memorabilia. These items often embody exquisite craftsmanship crafted with precision, often using premium materials, and are associated with prestigious brands. Luxury timepieces from renowned brands are more than just instruments that tell time, they are exquisite works of art and engineering. Investing in high-end luxury watches, especially limited edition or historically significant models, can be a prudent move. Not only luxury watches, but also fine jewelry, particularly pieces crafted by renowned designers and adorned with precious gemstones, holds enduring value. The rarity and beauty of high-quality jewelry can withstand economic fluctuations, making it a relatively safer asset class. Additionally, jewelry can serve as a form of portable wealth that can be easily traded or liquidated when needed. They are often regarded as functional art, showcasing the finest craftsmanship and design. Their appeal extends beyond just the material worth as they carry emotional value and sentimental attachments, making them highly desirable to collectors and enthusiasts. This emotional aspect can further boost their investment potential, as collectors are often willing to pay a premium for the pleasure of ownership. Art. Speaking of luxury pieces as functional art, another collectible that surprisingly is purchased and owned by so many rich wealthy individuals is art. Art, in all its forms, has long been considered a symbol of culture and human expression. Art is an incredibly diverse and captivating form of human expression, ranging from traditional paintings and sculptures to modern installations and digital creations. Owning art is an investment in culture and history, allowing you to immerse yourself in the creativity and stories behind each piece. Over time, the value of certain artworks can appreciate significantly, making art a potential store of wealth. Investing in blue-chip artworks refers to acquiring pieces from renowned artists with established reputations in the art world. These works often hold significant value and can fetch staggering prices at auctions. Owning blue-chip artworks can be seen as a safe asset, given their historical appreciation in value and consistent demand from art enthusiasts and collectors. Art serves as an effective diversification tool within an investment portfolio. Unlike traditional financial assets, which are influenced by economic and market factors, the art market tends to have a relatively low correlation with these asset classes. Therefore, investing in art can mitigate risks and provide a hedge against market volatility. The art market transcends geographical boundaries, with collectors and investors from around the world participating in auctions and art fairs. This global appeal ensures that high-quality artworks have a wide potential market, enhancing their liquidity and ability to maintain or increase in value. Next up after collectibles, let's look at an all-time best currency asset that has remained stable for years. Swiss franc. The Swiss franc, CHF, is the official currency of Switzerland and Liechtenstein. It is renowned for its stability, strength, and reputation as a safe haven currency. It has long been regarded as one of the world's most stable and safe currencies. What exactly does this mean? Well, during times of economic turbulence or global uncertainty, investors tend to flock to the Swiss franc as a safe refuge for their funds. Switzerland is known for its political stability, strong economy, and low inflation rates. These factors contribute to the overall stability of the Swiss franc. The country's commitment to financial prudence and neutrality in international affairs further bolster confidence in its currency. Switzerland's central bank, the Swiss National Bank, SNB, has a history of active intervention in currency markets to maintain the CHF's stability. The SNB sets an exchange rate floor against the euro to prevent excessive appreciation, which helps in ensuring a favorable environment for both domestic and international trade. As a safe haven currency, the Swiss franc provides an effective means of diversifying away from major currencies like the US dollar and euro. Diversifying into CHF can act as a hedge against currency risk and geopolitical uncertainties, ensuring your portfolio's stability and reducing potential losses during market turbulence. Switzerland's long-standing policy of neutrality in international conflicts enhances the Swiss franc's global appeal. Investors view the currency as detached from geopolitical tensions, adding to its attractiveness as a secure asset. Another asset safer than cash is precious metals. Precious metals, also known as commodities, are a group of rare and valuable metallic elements that have been highly prized for their beauty, rarity, and industrial uses for centuries. These metals are considered commodities because they are tradable goods that hold significant economic value. The most popular precious metals include gold, diamonds, emeralds, gemstones, and silver. Gold is the ultimate classic safe haven asset. It has been used as a store of value for millennia, and its allure remains strong even in modern times. During economic uncertainty, investors often flock to gold as a safe asset, driving up its price. While not as widely recognized as gold, diamonds, emeralds, and other gemstones can be valuable and are considered alternative investments. Though often associated with jewelry, they also hold investment value. Their scarcity and uniqueness can drive their worth, making them attractive assets for diversification. Silver is often referred to as the poor man's gold. While its value tends to be more volatile than gold, it also serves as a safe haven asset during economic turbulence. Additionally, silver has various industrial uses, providing it with an extra layer of demand. Unlike paper money, precious metals have intrinsic value. They are tangible assets that can't be easily created or destroyed by a government's monetary policy. During times of economic instability, precious metals tend to hold their value better than cash, which may lose purchasing power due to inflation. Investing in precious metals can also offer diversification benefits to a portfolio. This diversification can help protect your wealth from market volatility and currency devaluation. Raw materials. Raw materials, also known as industrial commodities, are the building blocks of economic growth. They encompass various natural resources exacted from the earth to produce goods. Examples include minerals, agricultural products, and energy commodities like crude oil and natural gas. Investing in raw materials allows investors to participate in the global economy's foundation and tap into the demand for essential resources. Raw materials play a crucial role in the global economy, and their demand tends to be relatively stable, especially for essential resources like oil and food. As a result, investing in raw materials can be a hedge against inflation, as their prices often rise in tandem with the cost of living. By investing in raw materials, you diversify your portfolio into a different asset class, reducing its correlation with traditional financial markets. This diversification can help protect your investments during economic downturns and other unforeseen events. Now let's move to another set of safer assets known as financial assets. These are the commonly known traditional assets and the most discussed in the realm of investing. Dividend stocks. Dividend stocks are shares of companies that distribute a portion of their earnings back to their shareholders in the form of dividends. These dividends are typically paid out regularly, often quarterly or annually, and are a tangible way for investors to receive a share of the company's profits. Unlike cash in the bank, dividend stocks provide a continuous stream of passive income. This income can be reinvested or used to meet your financial needs, giving you a regular source of cash flow. In addition to the income they generate, dividend stocks also have the potential for capital appreciation. As the company grows and increases its profits, the stock's value may rise over time, enhancing your overall returns. By investing in a diversified portfolio of dividend stocks, you can spread your risk across various industries and sectors. This diversification helps protect your investment from the potential downfall of a single company or sector. Dividend stocks have historically shown the ability to outpace inflation. Unlike cash, which may lose value due to inflation, dividend payments tend to rise over time, preserving your purchasing power. Index funds. An index fund is a type of mutual fund or exchange-traded fund, ETF, that aims to replicate the performance of a specific market index, such as the S&P 500. Instead of trying to beat the market, index funds seek to match their returns by holding a similar mix of assets as the chosen index. Index funds provide investors with exposure to a wide range of stocks or bonds, depending on the index being tracked. This diversified approach reduces the impact of individual stock volatility and minimizes the risk associated with owning only a few securities. They are generally more cost-effective than actively managed funds, as they require less frequent trading and have lower management fees. Over time, these lower costs can significantly improve your overall returns. The passive nature of index funds means that there is no need for frequent buying and selling of assets, reducing the risk of human error or emotional decision-making. Over the long term, many index funds have consistently outperformed the majority of actively managed funds like other mutual funds. Their consistent performance and low fees make them a compelling best option for risk-averse investors. High-yield savings accounts. A high-yield savings account is a type of savings account offered by certain financial institutions that provides a higher interest rate than traditional savings accounts. These accounts are typically offered by online banks and credit unions, and they are designed to help your money grow while remaining easily accessible. These savings accounts offer significantly higher interest rates compared to traditional bank accounts. This means that your money will earn more over time, increasing the value of your savings. Just like regular bank accounts, high-yield savings accounts are usually insured by the Federal Deposit Insurance Corporation, FDIC, in the United States or similar institutions in other countries. This insurance protects your funds up to the maximum limit allowed by law, providing an extra layer of safety. While investing in stocks or funds may involve locking up your money for an extended period, high-yield savings accounts offer a high level of liquidity. You can access your funds quickly and easily whenever you need them without facing penalties. High-yield savings accounts are considered low-risk investments. They are not subject to market fluctuations like stocks or funds, making them a reliable option for preserving your capital. Certificate of deposit. A certificate of deposit, commonly known as a CD, is a time deposit offered by banks and credit unions. When you invest in a CD, you agree to deposit a specific amount of money with the institution for a predetermined period, known as the term. In return, the bank pays you interest at a fixed rate over the term, and at the end of that period, you receive your initial investment along with the accumulated interest. CDs are considered one of the safest investments because they come with a guaranteed return. Unlike other investments that may fluctuate with market conditions, your earnings with a CD are locked in from the beginning. Just like keeping your cash in a regular bank account, CDs are also insured by the Federal Deposit Insurance Corporation like high-yield savings accounts in the US or similar entities in other countries. This means that even if the bank faces financial difficulties, your principal amount, up to the maximum insured limit, remains protected. The fixed term of a CD offers stability and predictability, as you know exactly when you'll receive your money back along with the interest earned. This is helpful for short-term financial goals or when you want to avoid market volatility. And since they are backed by the FDIC and have a fixed rate of return, they are considered low-risk investments. This makes them an ideal choice for risk-averse investors who prioritize the safety of their money. Treasury inflation-protected securities. Treasury inflation-protected securities, commonly known as TIPS, are government-issued bonds offered by the U.S. Department of the Treasury. These bonds are designed to protect investors from inflation by adjusting the bond's principal value based on changes in the Consumer Price Index for all urban consumers, CPIU. As inflation rises, the principal value increases, and vice versa. One of the primary reasons investors turn to TIPS is their ability to provide a hedge against inflation. In times of rising prices, the value of TIPS increases, ensuring that your purchasing power remains intact. TIPS are backed by the full faith and credit of the U.S. government, making them one of the safest investments available. The government's obligation to repay the bond at maturity provides a high level of security. They pay interest semi-annually, providing a steady income stream. This can be advantageous for investors seeking a predictable cash flow. While we often worry about inflation, TIPS also provide protection in times of deflation. If prices fall, the bond's principal value adjusts downward, but the investor is still guaranteed to receive the original face value at maturity. iBonds. iBonds are another type of government-backed bond issued by the U.S. Department of the Treasury. They offer a combination of a fixed interest rate, which remains the same for the life of the bond, and an inflation rate that adjusts every 6 months based on changes in the CPIU. Like TIPS, iBonds are designed to protect against inflation. The inflation rate component ensures that your investment keeps pace with the rising cost of living, preserving your purchasing power. iBonds are issued and guaranteed by the U.S. government, making them a safe and reliable investment option. The interest earned on iBonds is exempt from state and local income taxes. Moreover, if the bonds are used to finance higher education expenses, the interest may be entirely tax-free. While it's best to hold iBonds for at least a year to avoid early redemption penalties, they can be held for up to 30 years. This flexibility makes them suitable for both short-term and long-term financial goals. Real estate investment trusts, REITs. Real estate investment trusts are companies that own, operate or finance income-producing real estate. Think of them as real estate stocks. You buy shares of a REIT, and in return, you become a part owner of a diversified portfolio of properties in various sectors, such as residential, commercial, healthcare, or industrial properties. These companies pull funds from individual investors like us to acquire and manage real estate assets. By law, a REITs company in the U.S. must distribute at least 90% of their taxable income to shareholders in the form of dividends, making them an attractive source of passive income. This percentage may be different in each country, so do your research and due diligence. REITs offer a safety net through built-in diversification. When you invest in your money is spread across a variety of properties and locations. This means that if one property underperforms, your overall investment won't be severely affected, reducing risk compared to owning a single property or just holding cash in the bank. Unlike owning physical real estate, which comes with high upfront investments, responsibilities, and management hassles which may not be feasible for everyone, REITs are professionally managed by experts in the real estate industry. They are publicly traded on stock exchanges, and you can start investing with as little as the price of a single share. So you don't handle any expense, the company handles everything, from tenant issues to property maintenance, allowing you to be a hands-off investor and focus on other things. Annuities. Annuities are financial products offered by insurance companies. They are designed to provide a stream of income during retirement or a specified period. When you purchase an annuity, you make a lump sum payment or periodic contributions to the insurance company. In return, the insurance company guarantees regular payments to you over a set period or for the rest of your life. Annuities offer a guaranteed source of income, which is particularly valuable during retirement. Unlike cash in a bank account, which may be depleted over time, annuity payments provide a steady stream of income that you cannot outlive. Annuities offer tax-deferred growth, meaning you don't pay taxes on the earnings until you start receiving the income. This can be beneficial, as it allows your money to grow faster over time. Annuities come in various types, including fixed, variable, and indexed annuities. Each type offers different features and benefits, allowing you to tailor your annuity to your specific needs and risk tolerance. So it's essential for individuals to carefully evaluate their retirement needs and risk tolerance before deciding on the most suitable annuity for their financial goals. Private equity. Private equity refers to investments made in privately held companies that are not publicly traded on stock exchanges. These investments are typically made by institutional investors, high net worth individuals, or private equity firms. Private equity investments can involve purchasing equity in a company, financing startups, or taking ownership of struggling businesses. Private equity investments have the potential to offer high returns, often exceeding the returns of traditional stock markets. This can significantly boost your wealth and portfolio performance. Private equity investments are actively managed by professionals with expertise in identifying and growing businesses. Unlike passive investments like cash in the bank, private equity allows you to have a more hands-on approach to building wealth. Including private equity in your investment portfolio can provide diversification benefits. It offers exposure to different industries and sectors that may not be accessible through public markets. Private equity investments typically have a longer investment horizon, which aligns well with long-term financial goals. This longer time frame can mitigate the impact of short-term market fluctuations. The bank may have misled us into believing that it's the safest haven for our money, but we now know better. These assets are the true guardians of our wealth, standing tall against economic uncertainties and preserving our financial future. So, join us in this captivating journey towards genuine financial empowerment, where you take the reins and make your money work for you. Remember, your wealth deserves more than to collect dust in a vault. It's time to let it shine and thrive in the world of safer, more rewarding investments. Embrace the world of safer assets, and let your wealth find its true potential. Hope you found the video helpful. If you did, give it a thumbs up and kindly support the channel by subscribing to stay tuned for more exhilarating insights and embark on a path to financial success like never before.